emerging market economist with Morgan Stanley, joins us. Manoj, good morning. Thank you for joining us. What would you attribute the great unwinding in emerging markets to? Is this growth concerns, or these are concerns only emanating because of what Fed could do in the month of September?
So these unwinds are clearly a natural consequence of the build-up that we had seen, and the build-up came from U.S. monetary policy side. Given the issues that they had with their domestic economy, monetary policy was very, very aggressive. Real rates were negative, and over the last decade, China's spectacular growth has meant credit has gone up. But particularly in the post-crisis period, Chinese policy has encouraged growth to rise on the back of domestic credit expansion. And the combination of both of those really led emerging markets to have their own credit cycle. And in some places, credit growth had outstripped nominal GDP growth quite aggressively. As you see the U.S. economy recovering, you see less need for monetary accommodation there. At the same time, Chinese policymakers now realize that they have to move in a fashion to consumption-led growth, but at the same time also reduce some of the leverage that has been built up in the system. And the combination of those does mean that emerging markets will face a situation in which they have to be more careful, particularly in places where credit growth had outstripped nominal GDP growth. And the combination of that is really the triple unwind, which we've called the great unwind in our note.
Manoj, hi, morning. Is the situation then as grim as the 1997 crisis?
In some senses, the emerging market story has moved well beyond the 1998 crisis in a good way. The monetary policy stability, the macroeconomic stability, the FX reserves, all of these stories have actually moved emerging markets to a more fundamentally sound position. We have seen a degeneration, however, of emerging markets' growth. And the links that they have to developed markets, particularly through foreign ownership in the domestic bond market or the funding of the current account deficit, both of these do render emerging markets vulnerable to anything that international or global investors might see as something that is a worrisome trend, and that always opens them to the risk of a sudden stop.
Manoj, most emerging markets, central banks and governments, in attempt to stabilize their currencies, are now taking steps of monetary tightening. Do you think that's a bad strategy? Because if they tighten further, it will have impact on growth, and in the current environment, growth is precious and one should protect growth rather letting it go away.
I'm not really sure they have much of a choice. Just to give you some background, if you looked at 2008 and 2011, what central banks were able to do was to shed FX reserves aggressively to defend the currency, and that allowed them to use monetary policy for dealing with domestic demand. What has changed this time around is that in the lead up to the sell-off in May and June for the last year, FX reserves have not been increasing, and particularly with what the Fed is likely to do over the next 18 to 24 months, there is a chance that there is no FX reserves build up. Because of that, central banks in emerging markets are a lot more worried or a lot more careful in using FX reserves aggressively because they may not get them back. And that naturally means they have to use interest rates to defend both the currency and domestic growth. One of them is going to get hurt. Typically speaking, defending the currency is the way that you actually end up ultimately protecting growth, because you have to hurt growth in the near term to make sure that whatever problems that you've got, maybe a current account deficit, maybe too much of exposure from portfolio inflows, that imbalance is reduced, and that can actually help growth over a longer period of time. But the near-term pain does have to be borne. There's no real choice about that.
Manoj, how real is the risk then to fund flows on possible Fed tapering in the September meeting?
So the chances are that the Fed will taper in September, but obviously the sell-off of the last few months has been in trying to build that up. I think we should be careful in not just attributing what's happening in emerging markets to the tapering story. The tapering story has been a wake-up call for global investors to start thinking about emerging markets, but they are also very, very concerned about what the domestic dynamics in these markets are. So in equal measure, at least, I would say that the domestic dynamics and the policy responses in emerging markets are the ones that are also hurting emerging markets right now. If the Fed tapers in September, a lot of that has already been priced in. unless you get a very aggressive tapering, which frankly we don't expect at this point in time, I think markets have anticipated that. To make that point again, what's really driving markets also is what's happening in emerging markets themselves, not necessarily what's happening in the US.